The first thing we'll talk about, we call it an instant income increaser, three crypto tax secrets to 3x your revenue. A lot of this comes from an email campaign that we did. It was a 5-day email campaign on how you can build a crypto tax practice. If you're interested in that, reach out to us after the presentation. We'll get you signed up on the list. But a lot of this stems from that. The first thing that we know is that there's going to be a massive demand increase for crypto tax services. A couple reasons for that. One is that, over 20% of US people, US citizens now have some sort of exposure to crypto. A lot of that might be unreported. There's still people holding on to the old logic pre-2014 that, crypto is kind of invisible to the government. They'll never find you. So they don't report a lot of things, even though it's been a law on the books, for at least 10 years now. At the end of this year, a lot of players in the crypto space are going to have to start reporting 1099s on all the transactions that occur. Pretty much every player in the crypto space, be it an exchange, a DeFi protocol, a wallet provider, buyers, stakers, really anybody who affects crypto transactions is going to be responsible for reporting those transactions on a 1099 series form. We think it's going to be the 1099 DA. That's a special form that the IRS has put in the draft for, but not finalized yet. For the DA stands for digital assets, that deals with digital assets. But at the very least, there's going to be a lot of activity reported. The IRS is estimating that when the laws fully go into effect, they're expecting about 8 billion information returns from various crypto reporting entities. That's billion with a B. So that's a lot. So the gist of that is that there's going to be nowhere for people to hide. People who previously haven't been reporting crypto transactions are now going to be forced into it because, as we all know as tax practitioners, every time we receive a 1099 in the mail, the IRS receives one too. So they're going to be looking for it now. Crypto tax preparation is going to be it's already very complicated, way too complicated for the average investor. And it's going to become even more complicated on the back of the 1099 reporting. There's a couple reasons for that, but the big reason has to do with the nature of crypto itself, right? It's a self-custodied asset. It's easy enough to buy crypto on an exchange, transfer it to a cold wallet, transfer it again, wait a little while, and put it on a different exchange and sell it. And the issue is in the chain of custody and in the chain of data around that, because along with the 1099 reporting comes the requirement for these exchanges to report cost basis information, which a lot of them are not going to have, and they're going to have no access to get it. So the bottom line is that many of these 1099s are going to be wrong, and we're going to have to do a lot of manual work to figure out what the cost basis is going to be. There's no sort of equivalent to like the ACAT system that's used in traditional brokerages, where if you buy a stock at Fidelity and then you transfer that stock to Schwab, a couple of weeks later, the cost basis information gets transferred over to Schwab and you wind up with a correct 1099 at the end of the year. Nothing like that exists yet in the crypto space, and it probably never will. It may at some point exist at the exchange level, but when you get into some of these smaller protocols, these DeFi protocols and staking pools and things like that, they're never going to buy into that. Accounting is just a cost center for them. It doesn't benefit them in any way. So a lot of the legwork is going to be left up to us as practitioners to try to solve for the missing cost basis. And that's really what the first 3 bullet points here are: third-party versus self-reported information. A lot of the third-party information is going to be wrong by default. Data exchange problems because exchanges aren't sharing data yet. Cost basis issues are the big thing because along with the cost basis that's required to be reported, the other thing that we know is that's required to be reported, we've all seen 1099s before, is the gross proceeds. And we've seen this bear out in the past when certain exchanges were producing 1099 series forms for investors. A couple of years ago, Coinbase let off a bunch of 1099 miscellaneouses with only the cost basis reported. And that led to a lot of CP2000 notices amongst investors, with the IRS claiming that the entire gross proceeds should go on a Schedule C. And so, in our practice, we handled a lot of those issues. We had, one guy who was doing bot trading. He got a 1099 for $3.5 million. It turned out it was just a ton of trades with about a $7 value. So you can imagine how many trades that was. But we went back and did the legwork and figured out the cost basis. And it turns out in his $3.5 million of gross proceeds, he only made a profit of a few $1,000s. So the IRS wildly overstated the tax due because they had a lack of information. We'll go to the next slide. Yeah. How crypto tax differs from traditional tax. The big thing here is volume, right? Crypto lends itself to ease of access and ease of use. And the fact of the matter is that there's a lot of platforms out there that have, bot trades built in. So you're doing a ton of transactions in a short amount of time. There's a lot of user experiences on these DeFi protocols that equate to, big, bright colored buttons that you could push. And so you go on these web pages and you start clicking around, and before you know it, you realize that every click is a transaction. Every click has a taxable component. And so you get to the end of the year and you go to reconcile your transactions, and it's not uncommon for a person to have thousands and thousands of transactions that they didn't even know about until they, consolidated all that information. The industry itself is rapidly evolving. It used to be just a lot of trading. Then staking came along, mining came along, and that kind of confused it a little bit. Then things like DeFi came along, and DeFi it's kind of a buzzword in the industry because it means, decentralized finance, obviously, but it really doesn't mean anything because it's kind of just this one word that attempts to encapsulate everything else beyond just trading, really. And that could be anything. That could be lending. That could be, liquidity pools, things like that. We have GameFi now, people gaming to earn money, and every transaction that occurs in the games is a taxable transaction. So it's rapidly evolving. It's not uncommon for Sharon and I, particularly during the last bull run, and probably, upcoming this next one, to every couple of weeks or every month, find out about a new protocol, a new coin, a new platform that we'd never heard of before. And then we have to do a full workup of what exactly is happening at the transactional level so we can determine the tax attributes. There's fluid crypto tax rules. We still don't have a lot of guidance for the IRS on this. Not that it's entirely their fault, because Congress makes the rules and the IRS just kind of writes them. And Congress doesn't seem too willing at the present moment to give us, kind of an omnibus crypto tax bill. They're just kind of doing this piecemeal. So there's a lot of rules that are going to change, and we don't know the full extent that they're going to change. So that's going to be interesting to see how that plays out in the future. And then a deep understanding of crypto transactions. This really depends on the individual practitioner, but you can go into the weeds here. There's a lot of these protocols that are incredibly specific. You can spend a lot of time learning exactly how they work and become a subject matter expert. And that can position you quite well to really niche down even further within the crypto niche and attract a good clientele there. Go ahead, Sharon.
All right, I think it's my part now. Okay, so the next item we're going to talk about is some time-saving tactics that can help you. And from what Phil just mentioned, we know the crypto tax niche is full of opportunities. There's a huge demand out there, but also we know that not every tax pro successfully breaks into this industry because there are some various challenges there. And many tax professionals struggle to profit from serving crypto clients because they approach crypto tax preparation just like traditional tax return preparation. This one-size-fits-all mindset often leads to many challenges from, for example, making costly errors on clients' tax returns to not keeping up with the ever-evolving tax laws that Phil just mentioned, specifically related to cryptocurrencies. And this kind of missteps not only limit profitability, but also undermine the trust and satisfaction of their crypto-savvy clients. So in this part of our presentation, we are going to explore the most common mistakes tax professionals make and how to avoid them. Mistake number one is misidentifying taxable events. People often misidentify taxable events in crypto due to several reasons. First, treating crypto like fiat. Many tax professionals apply principles of fiat currency taxation to crypto without considering the unique aspects of digital assets. For example, when you buy something with a fiat currency, it's not a taxable event. You don't need to do anything. But if you use crypto to buy something, it's treated as a disposal of the crypto, and then use the money from the deemed disposal to buy the item or service. So this could trigger capital gains tax just because you have to report that deemed sale of crypto. Second is the lack of familiarity with crypto transactions. There's a knowledge gap regarding the nature of crypto transactions and how they should be treated for tax purposes. For example, some people still don't know that crypto assets received from like airdrops or hard forks are considered taxable income at which you need to report at the time of receipt and based on the fair market value of the crypto upon receipt and measured in USD. Third is the misconception about realized and unrealized gains. Believe it or not, some people are still confused about tax treatment of crypto for crypto exchange versus holding a crypto that has depreciated or appreciated in value. So there are still questions about that that we heard a lot of the time. Now, some of the most frequently misidentified transactions include, for example, using crypto for purchases. As I mentioned earlier, this can trigger a capital gains event, which is frequently overlooked by some people. Or converting one crypto to another, as we just mentioned as well. Many people still thought trading crypto for another crypto is not taxable. They thought, I only need to pay tax when I cash out, okay, which is not true. So trading crypto for crypto is a taxable event, just similar to selling crypto for fiat currency. You have to report it as a trade. The next is receiving debit or credit card cash back reward in crypto. Now, this is the opposite situation. Some crypto investors, we have seen that they thought receiving a crypto as a reward from using their crypto debit or credit card is considered income. They will have to report it as taxable income on their tax return, which is not true. Because just like receiving cash back, rewards from your traditional debit or credit card, you never report them as taxable income on your tax return, right? So it's the same for crypto. You don't need to report that as taxable income. To avoid misidentifying taxable events mistake, we just need to remember one simple rule. Maybe it's not so simple, but it is this. Except in a few cases, such as moving your crypto asset between your own wallets, so between your own accounts, or gifting or donating crypto, or receiving cashback rewards, just like I mentioned, from using your crypto debit or credit cards, or borrowing or lending crypto, etc. So those few exceptions probably are the only non-taxable events. Other than that, virtually every crypto transaction triggers a taxable event. So you just need to keep in mind about that. All right, so the next mistake is not utilizing crypto tax software or misusing it. It may be hard for some of us to believe, but the fact is some tax professionals are still using Excel to do crypto tax calculation for their clients. The necessity of using crypto tax software cannot be overstated. Crypto tax software offers several key benefits, such as integration with exchanges and wallets. It provides real-time transaction tracking by integrating with various crypto exchanges, wallets, those accounts to ensure transactions are being imported in real time. And so all the records are there and everything is up to date. Also, crypto tax software can provide accurate cost basis tracking and gain and loss calculation, which dramatically reduces errors in reporting capital gain and losses. And this kind of accuracy is crucial in the volatile world of cryptocurrency, where each transaction can significantly impact the tax outcome. All right, another example is, another benefit is automated tax reporting. Crypto tax software simplifies the complicated process of generating necessary tax forms and reports. This automation is a significant time saver, right, for both clients and us as a tax practitioner, allowing us to focus more on an analysis rather than doing manual data entry. Despite of these advantages, there is a common pitfall, okay, we need to keep in mind, which is the over-reliance on crypto tax software to do the work without a thorough review process. Crypto tax software indeed is a powerful tool, but relying solely on it to generate tax reports without a detailed reconciliation process can lead to inaccuracies. Just like with any software, the output is only as good as the input, right? So it's the classic case of garbage in, garbage out. So we need to keep in mind about that. Here are some best practices for using crypto tax software. One is to perform detailed reconciliation. It's essential to cross-verify the data from the blockchain. We cannot just purely rely on data import, an API, or a wallet address import. It does not mean that it all is guaranteed that the complete transaction data, they are all accurate. They are all completely, will be all completely imported. It also, we will need to make sure that we have all the accounts in place and reconcile all the transfers between one account to the other account and verify them. Even with API import, if the ending balances are incorrect, we most likely will have to ask our client to provide a CSV report just to double check and see what is missing. Also, if the client received a 1099 from the exchange, we will also have to figure out how to reconcile that, because most likely the 1099 is going to be incorrect. All right, so this kind of reconciliation ensures that all transactions are captured accurately and completely in the software. So this is an extremely important step. Now, the second best practice tip is to address errors and missing data in the software. Just like I mentioned earlier, there's no guarantee that the APIs or the wallet address import can truly import all the transactions completely and accurately. So there will be, in most cases we have seen, almost all the cases we have seen, I should say, there are errors, or missing data after the transaction import. So we will need to address those and get them all resolved, okay, working with clients to identify what is wrong there. And so some common issues regarding errors, missing data include such as uncategorized transactions, meaning, for example, a lot of time, even if you for example, if you're doing mining and you only see deposits going into your wallet, the software is not going to be able to automatically classify them as mining income for you. So you will have to go and do that classification. All right. Or missing prices. So some lesser known tokens, or NFTs, those things, they may not have the correct pricing, which will impact your gain and loss calculation, or missing cost basis, or transaction history. Just like I said earlier, even if you're using API import, those kind of automatic import method, it may not bring in everything correctly. So you will have to go through that and make sure that you have all the cost bases correct, which you will ensure that your gain and loss calculation is correct. All right, the next mistake is failing to keep up with changing crypto tax laws. Crypto tax law, as we know, is still kind of like in its infancy stage and is always changing and shifting. So staying updated is crucial, but it's often neglected due to the busy schedules of tax professionals, especially in like a time like now. We are deep in tax season, so we are all busy. So we may not pay attention to all the changes in crypto tax law. So here are a few recommendations about how you can stay ahead. So definitely stay informed of all the crypto law, crypto-related regulations. And one place we recommend is a good place to start with, at least, is to regularly check the latest IRS guidance on digital assets, which you can find on the IRS website. Also, be proactive. All right, you can actually set up Google alerts for the latest updates in crypto tax laws. Just be proactive to make sure that you are always keeping up with the newest development. Continuing education, all right? Engage in crypto tax related continued CPE courses like this one, all right? You're doing definitely the right thing, okay? And the other webinars in this crypto tax and accounting conference that crypto CFOs organized. So this is a great opportunity for you guys to get the education that you need. And the last one is networking. We recommend that you consider joining professional organizations or groups, again, such as crypto CFOs. So yeah, I'm not like purposely trying to advertise for them, but indeed, this is a very good place where updates and insights are frequently shared, and you can just get access to a lot of useful information there. All right, so now let's turn to Phil for the next presentation.
All right, 3 rapid steps to dominate the crypto tax niche. The first step is going to be to master the basics of cryptocurrency. And the easiest way to do that, what I recommend to everyone, is to learn by doing. We have a really unique opportunity, and that kind of dovetails with one of the ideals of crypto in general, which is unfettered access to anyone in the world with an internet connection. And here we are, all of us sitting on a Zoom webinar, so we can check that box. All of us have the ability right now to go to Coinbase or to Kraken or any of the big exchanges, set up an account, use a debit card to buy a little bit of Bitcoin, buy a little bit of ETH or Solana, whatever you want to do, and just kind of start playing with it, start feeling it around. Move it to a cold wallet, interact with the DeFi protocol, understanding all the time that everything that we're doing more than likely has a taxable component, and we'll have to report on our taxes. But there's no better way to learn about this stuff than by getting our hands dirty. This niche is unique in that, there's real estate CPAs. You can imagine, if you were to buy a bunch of rental properties and manage them for a few years, that would be a great learning opportunity, but it's cost prohibitive. There's people who specialize in doctors and dentists. Well, you don't need to go to med school to figure out this, the whole crypto tax thing. The best way to do it is just to dive in, roll up your sleeves and start interacting with it. You'll learn the lingo, you'll learn how it all works. You'll become much more able to talk about it to clients and present it, more casually, because you'll have been there and have done that before. The second one is free online courses. A couple good ones that we recommend are MetaMask Learn and Coinbase Learn. Coinbase Learn is really great. It's got little kind of snippets about each new protocol, and you read a couple slides, a little slideshow, take a little bit quiz at the end of it, and then they'll actually reward you. They'll actually give you a couple dollars worth of whatever the cryptocurrency is that you just learned about. So you kind of get paid to learn, but it's great to kind of get the basics down, how some of these things work. And then third is authoritative resources or kind of more steady resources. The best page there is the IRS guidance on digital assets. They have a digital assets landing page. If you go to irs.gov, just type digital assets in the search bar, it'll pop up, and it's got pretty much everything listed there, starting with the notices, the FAQ page, all the different revenue rulings that have come down so far. There's not a lot there because there haven't been a lot of guidance given from the IRS yet, but everything that they have published thus far is available on that landing page. It's a great resource, as a tax professional in this space. Then you've got the AICPA, you've got the Big Four. They've all got their blogs, they've all got their articles. There's a wealth of knowledge to be had online. And so we recommend you check that out. We'll go to the next slide. How to choose the right crypto tax software. This is a big one because this is kind of going to be what underpins your whole practice. Things you want to look for are integration capabilities. There is a lot of different coins. There's a lot of different cryptocurrencies out there. There's a lot of different blockchains out there. Some softwares are better than others at integrating with these, whether through API or whether through different wallet import methods. So you want to make sure that whatever software you choose to use in your practice integrates with a lot of the coins that you're seeing your clients use. Are there reconciliation features? Things like missing transaction reports, so you know where there's only one-sided transactions. Things like cost basis validation errors, where you get like pricing issues and things like that. You want to make sure that when you produce a tax report, every single transaction on that tax report is linked to a cost basis, whether that's using FIFO or LIFO or any other specific ID methods. You want to make sure that there's a cost basis there because that impacts the overall gain that you're going to write down on your client's tax returns. There should be some sort of versatility in tax planning, and really this breaks down into two things. One is the basis allocation method, like I just mentioned. Most of the softwares will say that they can do either FIFO or specific ID, which are the two methods allowed by the IRS. Specific ID is really some sort of algorithmically determined thing at the software level. Some of the softwares do it by trying to minimize gains. Some of them do it by sorting for long-term gains over short-term gains and things like that. But really, you want to make sure that they're tracking everything that the IRS says that you need to track to qualify as a method of specific ID when you're talking about which tax lots you dispose of in a certain transaction. Some do, some don't. Make sure you know what you're getting into before you plunk down a bunch of money on a software. And finally, is there an accounting platform? Is there a way for you to consolidate all your clients under one roof, easily access all their accounts, look at everything, see everything, change everything if you need to make adjustments in your clients' accounts? And you probably will, because just hooking up the wallets, just hooking up the APIs, as Sharon mentioned, is almost sure to give you a bad result or an incorrect result. So you're going to need to go in and do some reconciliation work. So you want to make sure that the platform allows you to have that access to your clients' accounts. We'll go to the next slide. Build and train your team. Yeah, assess your practice's needs. Look, I think everyone on this call is probably running a tax practice or at least working in a tax practice. Tax practice is just a business. A business is just a set of processes. And a set of processes is just a bunch of people or machines or software doing tasks over and over and over again. So it's not a stretch to say that the success of the business depends on the success of the people who are in that business. You really have to find people who are passionate about this stuff You need to find people who have done what we said a little bit earlier and gotten their hands dirty. There's really no substitute for someone being involved personally with crypto, whether that means, just buying and selling on an exchange, or whether that means being a complete degen who lives on the computer all day, every day, and does all sorts of wacky stuff in the DeFi universe. They really need to have some skin in the game to understand it. Finding the right talent has a lot to do with that. Finding people who really care about this stuff, and who have seen it before, and who have the right mindset. A lot of crypto accounting is detective work, because you're going to hook things into whatever software you're going to use. It's by default going to be wrong or incorrect. You're going to have to go to block explorers. You're going to have to try to figure things out. You're going to have to drill down into transactional data that sometimes isn't presented very clearly, depending on that block explorer that you're using. And you're going to have to kind of, make a decision of how to interpret that data and apply it to your client's case. So it's not like traditional bookkeeping where, you're reconciling to a bank statement or something like that. The data is all available. It's all out there somewhere, but there's no strict format to it all. And so everything you see is going to be different. You're going to have to determine what it means. So it's a lot different than, traditional accounting. And then third is training your team. There's a number of great resources that you can use to train your team. We actually have a great course that we do on how to do crypto reconciliation. Sharon and I take you through all of that. If you're interested in that, let us know. But by all means, there's any number of great training programs out there. The key is just picking the one that is the best for your practice and making sure that your team understands it and completes it all. All right, Sharon, go ahead.
All right. Okay. Thank you, Phil. Okay. So next we are going to look at some simple steps to success, and about 3 upgrades that you can do to take your practice to the $500,000 mark. So Phil just gave you some steps to go from 0 to 1, but how do you build a highly successful crypto tax practice? Many tax professionals unintentionally cap their profits because they spend too much time working in the business, okay, like serving clients, and not enough time working on the business. So this common pitfall usually stems from several high-level operational challenges. Tax practitioners often struggle with, for example, outdated onboarding processes, which lead to communication errors and time-consuming rounds and rounds of document requests. So in their effort to build their client base, they may resort to hot selling techniques, okay, that really yield results. By choosing to work solo, they may also miss out on leveraging the tightly knit relationship and collaboration opportunities that are very common and very important in the crypto space. So those are things we need to pay attention to. In this section of our presentation, we will introduce 3 upgrades that can help you easily land, we believe, $500,000, okay, in crypto tax service fees. Now, upgrade number 1 is streamline your client onboarding process. First and most importantly, you want to use automated digital onboarding tool, because the number of transactions, wallets, and accounts can easily be 10 times of traditional finance. I'm talking about in crypto. So you must have a streamlined onboarding process, okay, to handle all that. Implement a system that allows new clients to seamlessly provide information, sign documents, or set up their account with you. Those things is very important. So this kind of efficiency will help you save time and presents your practice as a modern and client-focused. So it will give your clients a very good impression, if nothing else. An essential benefit of streamlining your onboarding process is the ability to gather accurate and complete data. That is one of the benefit of having a streamlined onboarding process. And this is critical, especially with regard to crypto tax, where accuracy in data is very important. Based on a survey of tax professionals referenced by Accounting Today, which is a magazine I think many of you probably have already read, they found that the biggest mistakes in crypto accounting are often due to missing or inaccurate data from clients, which based on the surveys, like 90%, 98% of the time. And a lack of a disclosure of assets and transactions for tax reporting from both businesses and individual clients involving in crypto. That accounts for 95% of time. So both issues we have experienced, okay, as a crypto tax firm. So we know that is very true, and those are indeed very serious challenges that we have to face and tackle. You can significantly reduce these errors by implementing an automated and efficient onboarding system, just like I said. Another thing that can help streamline your client onboarding process is to offer educational materials to clients. A lot of the tax information in the crypto tax world is self-reported, all right? Especially if you are using some like hardware wallet or you are involved in DeFi transactions, those things you have to self-report. So unlike traditional assets, typically report through third-party forms like 1099, if you are using a brokerage firm to invest in stocks, they will issue a 1099, so you don't have to worry about how to get the data, how to report all those things. But crypto is very different. So that means you need to, as a tax practitioner, you need to help your clients to help you, all right, by providing education materials that covers several essential aspects, such as understanding tax implications of their crypto transactions. So that this is a very important step because when your clients understand what is taxable, what is not taxable, that will help speed up the process of working with them a lot, rather than keep having to explain to them when you already are deep in the work. And the second thing is a complete disclosure of wallets and accounts. Okay, I cannot stress enough the importance of educating clients about this thing. A lot of clients, they still thought, I used a wallet or an account, exchange account a few years ago, but there's nothing there, so I don't need to report, right? I closed. I no longer have access to the account because I just decided not to use it anymore, or I lost the password or whatever. So I don't need to care about those accounts, right? Not really. Okay, everything counts. All right, everything will. And if you don't have everything, it is going to impact the accuracy of your crypto tax report. All right. So the next thing is wallet hygiene. All right. So this is very important. A lot of clients, even if they have been involved in crypto for several years or been doing a lot of different transactions, they still don't have a good understanding about wallet hygiene, which actually will it creates a lot of problems for us as tax practitioner. So we should guide them on maintaining good wallet hygienes to avoid complications, such as some clients, they have a business and they just mix up the use of their wallets with transactions related both to personal as well as their single member LLC or their S Corp. We have seen that quite a lot, and that definitely creates a lot of issues. And the next is identifying taxable events. A lot of people are still not very clear about how to do that. And so we need to clarify which crypto transactions trigger taxable events. just like I mentioned earlier during this presentation, it is the kind of education we should provide to our clients. And the last item is record keeping, right? And we all know that record keeping is extremely important. So we should offer tips to our clients about how to maintain proper records and how we can get all the information all documented, because if they end up with like an IRS audit or a tax notice, record keeping documentation is the key, right, to help them get through that. All right, so this approach, meaning providing education material to clients, will empower your clients, okay, with the necessary knowledge and also facilitate a smoother and more accurate tax reporting. It will also help your job a lot easier. And one more thing you can do is to provide personal initial consultation to your clients during the onboarding process. You can offer a consultation call or a kick-off call or a video meeting. We do prefer a video call versus a phone call, all right, so that you can see face-to-face and to connect with your clients personally and to address their specific questions and customize your service to meet each client's unique needs. All right. So offering this kind of consultation calls not only enhance the client experience, but also brings a multitude of benefits to both the client and yourself, such as building trust and a stronger client relationship, helping to tailor to each client's specific needs, just like I mentioned, and getting insights from clients to help you improve your process and your client service quality. By listening to clients is definitely a great way to help you improve your business. So, and it will also, of course, on the other hand, to other side, to allow your clients to ask questions and clarify any doubts that they may have. And the personal interaction, the connection will definitely help increase your client's confidence in you and your service. So I would say this is definitely a good step to take. The next is upgrade. The next upgrade is do not sell to your niche, educate them. All right, this is a little bit different than what I just mentioned about educating clients about the what is taxable, what is not taxable. Many tax professionals fall into the trap of aggressively selling their service. Okay, they just want to sell because that's how they can get revenue, right? They focus only on like closing deals rather than truly understanding and addressing their clients' needs. And of course, this approach can lead to disconnect, and clients will feel that you only want to earn money from them. You are not really truly care about them or trying to help them. So this will backfire on that. All right. So in the interest of time, I think I will have to speed up. So there are actually there are a few things that I just want to go for real quick. One is you can achieve that by developing engaging contents, by blog posts and things like that to help educate your clients. You can host webinars and workshops. Also, you can create infographics and videos, all right, to help your clients to get a better understanding about different things to provide value to them. And then the third and last upgrade is to partner with other crypto professionals. And many tax professionals make the mistake of navigating the crypto space in isolation. It's because they worry about competition, so they don't want to share the information with other people, thinking that then other people will be able to benefit from their knowledge or resources. This approach overlooks the opportunities and the collaborative spirit that prevails the crypto community. So crypto community is actually a very small and tightly knit space, and we tend to want to help each other. All right, so by embracing partnerships and collaboration, we can tap into a wealth of shared knowledge and resources. So there are tons of benefits. And you can shift your mindset from competition to collaboration by collaborating with, for example, financial advisors, team up with legal experts and or sharing clients with crypto software providers. So all those are very powerful, useful partnerships, and our firm utilizes them all, and we have been able to achieve great success. All right, Phil.
All right, yeah, let's wrap it up here. So these are the 3 best practices to scale from 500,000 to $1 million. The first is to provide high margin planning services. All of us are in the tax industry. All of us are in compliance by nature. We know there's nothing fun or sexy about compliance, and you can't charge a lot of money for it. You could charge more for crypto compliance than you can for traditional tax compliance. But really, the good deal here is in the planning services. If you can market yourself effectively as a person who can proactively help their clients lower their tax bill, you're going to be able to get a lot more money for those services. And that's the same, whether it's in a traditional tax practice or a crypto tax practice. The second one is be selective with your clientele. There's a lot of riffraff out there. Crypto lives on Twitter. It lives in Discord servers. It lives on longer form articles on Medium and stuff like that. There's a lot of people who read this stuff, and there's a lot of people who come to you because it's difficult to do on your own, but they don't necessarily want to pay the whole thing. They don't necessarily want to be what we would consider a good client. So you just kind of have to make sure that the people that you're bringing in to your practice are going to be people who are respectful of your time and respectful of your expertise. Along with that comes, what is your expertise, right? And that has to do with things that you've done at the platform and protocol level. If you start getting in there and participating in some of this stuff, you might find a protocol that you like. Back 2 years ago, there was a thing called Nodes as a Service. It was a new thing in DeFi. I got really into strong nodes for a while. I started writing about it, and that turned into 10 or 12 clients that had read my writings about that. You could do the same thing. There's new protocols, there's new platforms popping up every week. Get into one of them, start writing about it. Like Sharon said, start educating your potential clientele, and they will find you. We'll go to the next one, Sharon. Master crypto tax software to increase your operational efficiency. And we've talked about software throughout this presentation, but it is really important to pick the right software and to learn that software really well. You can be a half decent crypto reconciliation specialist with a working knowledge of most of the softwares, but you could be a really, really good crypto reconciliation specialist if you really double down and learn whatever software it is you're using. And a lot of that depends on, whether you're going to be using it for business or individuals. For individuals, you might use something like Cointracking or Coinly. For businesses, maybe it's Bitwave or Cryptio or something like that. There's a handful of good softwares out there, but the key is really learning the one that you're using so that you can effectively use it for your clients. It's going to add to, streamlined data management, enhanced accuracy. Some of the softwares now have analytical insights where you can analyze, income and spending. You can analyze capital gains. You can actually analyze future transactions. So there's like tax lot selection guides to minimize gains and things like that. And then time savings. The goal of any software is to eliminate the work of humans, right? And so if we think about doing all of this on one big giant Excel spreadsheet, I don't know how many hours it would take us to reconcile the average client, but it's certainly a lot less with effective software use. So go ahead, Sharon, take us home.
All right. Okay. So now we are up to a conclusion, right? Just to summarize what we have learned today. Number one is the faster you can adapt your skills and knowledge to crypto tax, the quicker you can start serving crypto clients, right? And potentially earn 3 times of the fees that you could earn from just doing traditional tax work. And second, by avoiding the common mistakes about crypto taxation, you can save time and elevate your practice to the next level, right? Number 3 is to, with comprehensive knowledge, of course, the right tools as well, and a skilled team, you can effectively set yourself apart and up for running as a front runner in the crypto tax niche. Number 4 is adopt upgrades such as streamline your process, connecting with your client base without resorting to hard selling, which is a big no-no, and building strategic partnerships with other players in the crypto community will help you achieve great success. Okay. And the last point is by offering high value tax planning services, be selective with your client base, and mastering crypto tax software, you will be well on your way to building a highly profitable or even multi-million dollars practice.